Financial analysis of Yum! Brands Incorporated. Executive Summary. The nuanced investment thesis for Yum! Brands Incorporated. Yum! Brands, Inc. presents a complex and multifaceted investment case that requires a nuanced perspective beyond simple valuation metrics. The company operates as a dual narrative of compelling growth potential and significant underlying financial risk. Yum! Stock is a classic growth-oriented investment, priced at a premium by the market due to its highly efficient, asset-light franchise model and the strong performance of its Taco Bell and international KFC divisions. However, this premium valuation is accompanied by a highly leveraged balance sheet and negative equity, which are notable structural risks. The company's bonds, rated as non-investment grade, offer a respectable yield but appear to be priced at a level comparable to or even below some investment-grade benchmarks, suggesting they may be overvalued relative to their formal credit risk. The company's dividend, while showing a strong growth rate, is a point of contention among analysts, with conflicting assessments of its long-term sustainability due to the company's financial structure. Based on a thorough analysis of both the equity and debt, an investor restricted to a single investment would find the stock to be the more compelling option. The stock provides direct exposure to the company's most powerful growth drivers and strategic initiatives, which are the very reasons the market is willing to pay a premium. While the bonds offer a stable income stream, they may not provide sufficient yield to compensate for their inherent non-investment grade risk. The upside potential in the equity, driven by the company's franchise-first model and global expansion, offers a more attractive risk-reward profile than the fixed and potentially compressed returns of the debt. Introduction to Yum! Brands, Inc. and its business model. Yum! Brands, Inc. is a global leader in the quick-service restaurant industry, functioning as the publicly traded parent company for some of the world's most recognizable brands: Kentucky Fried Chicken, Taco Bell, Pizza Hut, and the Habit Burger Grill. Founded in 1997 and headquartered in Louisville, Kentucky, the company has grown into a significant player with a market capitalization of approximately $38 to $40 billion. The cornerstone of Yum's corporate strategy is its asset-light, franchise-first business model. This model is a critical factor for understanding the company's financial profile. A remarkable 98% of all Yum locations are operated by franchisees, a strategic shift that has occurred over the past few years. This structure allows Yum to generate a stable and high-margin revenue stream, primarily from royalties and fees, which typically range from 3% to 6% of franchisee sales. By delegating capital expenditures and day-to-day operational burdens to its network of partners, the company minimizes its own capital risk and can scale its brands quickly and efficiently. This lean structure is directly responsible for the company's high valuation multiples and its highly leveraged balance sheet, as it prioritizes cash flow generation over asset ownership. Detailed equity analysis. The high-growth, high-risk proposition share price performance and market context. The performance of Yum stock has shown mixed results, often lagging behind key market benchmarks. Over the past year, the stock gained 4.8%, significantly underperforming the S&P 500 index, which rallied nearly 20.6% over the same period. Similarly, a comparison with its primary peer, McDonald's, reveals that Yum's 5% return over the last 12 months was far less than MCD's 15% growth. On a year-to-date basis, however, the picture is more favorable, with Yum's 5.9% return outperforming the Advisor Shares Restaurant ETF, which returned 1.5%, and performing closely with MCD's 6.58%. The stock is more volatile than MCD, with a volatility of 8.03% versus MCD's 5.01%, and its risk-adjusted performance, as measured by the Sharpe ratio, is lower at 0.23 compared to MCD's 0.82. Recent volatility was highlighted by a more than 5% drop in stock price following the Q2 2025 earnings report, with the company's adjusted earnings per share of $1.44 missed Wall Street's expectations of $1.45. Valuation metrics and the overvalued versus undervalued debate. A significant debate exists regarding the proper valuation of Yum stock. On one hand, traditional valuation metrics suggest the company is overvalued. The current price-to-earnings ratio is 29.31x, which is considerably higher than the restaurant sector median of 16.10x. This indicates that investors are paying a premium for each dollar of Yum's earnings. A discounted cash flow analysis reinforces this perspective, estimating the stock to be overvalued by approximately 37%. Zacks proprietary analysis assigns Yum a value score of D, categorizing it as a bad pick for value investors and recommending a hold rating. Conversely, other analyses point to a more reasonable or even undervalued position. Forward-looking PE ratios are cited in the range of 18x to 24.2x, which is considered a reasonable multiple for a company with Yum's brand strength and growth potential. A key factor in this divergence is the Mark T's valuation of Yum's unique business model. The asset-light strategy allows Yum to achieve superior asset efficiency and profitability metrics compared to its peers. For instance, its annualized asset turnover ratio is 1.14x, significantly higher than McDonald's 0.47x, and its return on assets is 22% versus McDonald's 16%. These superior metrics are a direct result of the company's lean, franchise-centric structure. Therefore, the market appears willing to pay a premium for a company that generates robust, capital-efficient returns, even if traditional multiples appear stretched. This suggests that the overvalued label is a product of a backward-looking analysis, while the more bullish sentiment is based on a forward-looking view of the company's strategic advantages and growth prospects. Analyst consensus and dividend analysis analyst sentiment for Yum stock is generally positive. The consensus rating from 27 analysts is a moderate buy, with a split of 9 strong buy ratings and 18 hold ratings. This is a more bullish configuration than was observed 2 months prior. The mean price target is $160.65, implying a potential upside of 13.1% from current levels, while the street high target of $185 suggests an ambitious upside of over 30%. The company has a strong dividend profile, with a history of paying quarterly dividends since 2016 and having increased its dividend for 8 consecutive years. The current annual dividend is $2.84, with a yield of approximately 2%. The company's 5-year dividend per share growth rate is 9.5%, which is categorized as very strong by AII. However, there is a notable divergence in expert opinion on the sustainability of this dividend. AI assigns the stock a dividend strength grade of D, suggesting the company may not be generating enough cash to consistently cover its dividends. In contrast, Dividend.com gives the company an A+ for dividend safety, citing a reasonable payout ratio that is in line with its sector. This conflicting view arises from the company's highly leveraged capital structure, which includes $10.42 billion in long-term debt and a deficit of $7.68 billion in shareholder equity. While the payout ratio might appear sustainable, a deeper analysis that considers the balance sheet structural weakness, as AI's metric likely does, presents a significant warning sign about the dividend's resilience in a downturn. 2% dividend yield, 9.5% 5-year dividend growth payout ratio. Growth drivers and investment risks. Growth drivers. Taco Bell's double-digit international expansion and profitability. ING. The Bell plan targeting 60% digital sales by 2030. KFC's Saucy sub-brand to appeal to younger consumers. Pizza Hut's shift to delivery and carry-out focused Delco model. By Yum. AI platform to streamline operations investment risks. High debt load and negative equity creating financial vulnerability. Uncertain success of KFC and Pizza Hut turnaround plans. Continued underperformance in the U.S. market. Exposure to climate-related market and physical risks. Potential impact of macroeconomic pressures and rising interest rates. Detailed debt analysis. The strong junk bond, paradox bond profile, and credit quality assessment. Yum. Brands maintains a robust presence in the corporate debt market with multiple bonds of varying coupons and maturities. A representative example is the 4.75% bond with a face value of $1,000, which matures on January 15, 2030. This bond has a yield to maturity of 5.2% and an outstanding amount of $800 million. Other bonds have YTMs ranging from 5.1% to 6.0% and maturities extending as far as 2043. Yum. Brand's credit quality is a central consideration for bond investors. S&P Global Ratings has affirmed the company's credit rating at BB+ with a stable outlook. A BB+ rating falls within the non-investment grade category, commonly referred to as junk bonds, signifying a higher risk of default than investment-grade securities. This rating directly reflects the company's significant financial leverage and negative shareholder equity, which are structural risks that must be carefully considered by debt investors. Bond valuation. The yield and the risk the valuation of Yum's bonds can be assessed by comparing their YTMs to relevant market benchmarks. Given the BB+ rating, a high GH yield corporate bond index will be the most direct comparison. However, the bond's yields can also be benchmarked against investment-grade indexes to understand how the market is pricing this risk. The MVIS Moody's Analytics US BBB Corporate Bond Index, representing lower medium-grade investment-grade debt, has a YTM of 5.2%. The Moody's Seasoned Bond Corporate Bond Yield is 5.99%. This comparison reveals a compelling market anomaly. Yum's non-investment-grade bonds, despite their higher official risk profile, are trading at yields that are comparable to or even slightly below some investment-grade benchmarks. This suggests that the market is pricing these bonds not solely on their credit rating, but on the perceived stability of the company's underlying cash flows. The predictable, high-margin royalty revenue from its asset-light franchise model gives bondholders a high degree of confidence in Yum's ability to service its debt. The market appears to view Yum as a strong junk bond, or a borderline investment-grade credit, and is therefore willing to accept a lower yield than what might be typically associated with a BB+ rating. For a bond investor, this could imply that the bonds are slightly overvalued for the level of credit risk, as the yield may not fully compensate for the possibility of default. Comparative analysis and final recommendation synthesis of findings. Stock versus bonds. The decision to invest in Yum stock or its bonds hinges on an investor's risk tolerance and investment objectives. Stock investment case. The stock is a direct investment in the company's growth story. The investment case is a bet on the continued success of its asset-light model, global expansion, and strategic brand revitalization. The potential for capital appreciation is significant, driven by the strength of Taco Bell's global growth and the ambitious turnaround plans for KFC and Pizza Hut. The primary risks for a stock investor are a high valuation that could be sensitive to market shifts, the leverage balance sheet, and the operational risks associated with a global franchise business. Bond investment case. The bonds offer a more conservative proposition focused on income stability. The investment case is a bet on the predictable and resilient cash flow generated by the franchise model, which provides a reliable stream for debt servicing. The bond's upside is limited to the yield, with the risk tied to the company's high leverage and the possibility that the current yield may not adequately compensate for their non-investment grade credit status. Final recommendation: if faced with the choice of investing in only one, the stock is the better investment. The rationale for this choice stems from a careful evaluation of the company's fundamental value proposition and how the market is pricing both securities. The core strength of Yum Brands lies in its unique business model, which allows it to generate significant, stable cash flow with minimal capital expenditure. This operational efficiency and growth potential are the very reasons the market affords the company a premium valuation. While the stock's price may seem high based on some metrics, it is paying for the company's future growth and strategic execution. Conversely, the bonds, while offering a stable income stream, are priced at yields that appear to be at the lower end of what one might expect for a non-investment grade credit. The market seems to have already priced in the stability of the company's cash flows, meaning the bond investor may not be getting a sufficient premium for the risk they are taking. The strategic initiatives to revitalize struggling brands and the robust performance of Taco Bell offer a clear path to potential capital appreciation that the bonds simply do not provide. The stock, while inherently more volatile, offers a more compelling risk-reward profile, as it allows for direct participation in the company's upside, which is the very reason the market values it so highly. For an investor with a long-term horizon, the stock offers the most direct exposure to the source of Yum's fundamental strength and strategic advantage.